Um, one of the things that we look at when we're looking at all of these new things, mobile banking and social media and all of these disruptive forces, is a lot of question about how quickly do I need to be thinking about this for my bank? That's probably the number one question. You know, we hear all about this all the time. There's all these startups in the news, all these different players. There's so much complexity, it seems. So much, there's so many choices of what to do. So when do we need to start? How quickly do we need to move? And what should we be doing? These are the questions I get asked all the time. So what I thought I'd start with is, rather than sort of try and jump into technology solutions, because when you jump into the technology of the thing, you can say this technology does it, but that technology equally can do it. So rather than jump into technology, I thought I'd step back from that and say, how are customers behaving? And what does that tell us about where we have to go? Because in every other industry where we've seen disruption, it's been led by consumer behavior change or consumer behavior shift. Great examples: the book industry, the newspaper industry, the music industry. There's been innovations in those industries for sure, but if those innovations happen and customers didn't like those innovations and they didn't behave any differently, then those businesses would never change. So consumer behavior change is a great way to figure out where we have to go. And right now what's happening is consumer behavior in banking is changing faster than it has ever changed before. So we got this gap opening up, right? Consumer behavior is going off here rapidly, and banks are going, so what is it that we should be doing? And what is this mobile stuff and social media? How do we use social media? And customers are going off, and there's 1 billion customers on Facebook, and all mobile adoption, 50% mobile adoption of smartphones, and should we have an app? This is the dilemma. This is the dynamic. So I want to get into that, into the consumer behavior stuff. Now, one of the problems we have as an industry is we have some branding issues, right? With banking as a whole. And the problem is that we start with a premise that as community banks, and this is even more so than the big banks, we start with the premise that customers like to work with us and they trust us because we're in the community. The problem is that we are now suffering from this lack of trust overall in the industry. And I'll put it this way. It's not so much that they don't trust banks anymore. I think it's a little bit more complex than that. Consumers have been burnt by the whole global financial crisis. I think they trust their money is safe with a bank, but they don't trust what banks tell them anymore. This is the collective challenge we face. Now, this is a problem for us because one of our core value propositions as banks in community has been, you can trust us, we know who you are, we're right there in the community, and we can help you with whatever you need. But consumers are like, well, all banks are pretty much the same these days. That's the tough thing we have to get over. How are we engaging customers in this environment? How are we going to rebuild this trust? How are we going to improve the way we communicate and touch customers? So traditionally, this is how we've reached out to customers. We put a TV commercial on. Now, it's really funny. I guess you guys are aware of the fact that brands like Coca-Cola, Microsoft, Apple, these big companies, McDonald's, that used to spend tens of millions of dollars on TV commercial advertising. These guys have pulled, in some cases, Coca-Cola's reduced their TV advertising spend by 70% over the last 5 to 10 years. Why? DVR. Right? We record our favorite shows, we come home of an evening, we put on the show, and we fast forward ads. We don't watch ads anymore. Now, I've got a lot of community bankers going, oh, but this is great for us. We can afford to do TV advertising now because the big guys aren't doing it. It's like, why aren't they doing it? Because it's not working as effectively. But this comes back to a core problem in terms of the way we engage with customers. In the past, we sent out all of these messages. We said, we'd send out newspaper ads, TV commercials, we'd put billboards up, we'd send out these mail envelopes, and we'd say, you guys can trust us. We're different. We're a great bank. We're in the community. We know who you are. We've got the best rates. We've got the most branches in this community. You can trust us. And we'd send all these messages out, and we'd sit there, and we'd wait. And we'd wait. And then they'd come in the branch, and they'd sign a piece of paper, and then they would wait for a few days while we figured out whether or not we wanted them to be our customer. We call that risk and compliance processes, right? And then, if they were lucky, we'd let them be our customer. This was the traditional engagement model, right? Send out these messages, funnel them into the branch, go through this compliance process, and maybe if they were lucky, we might give them a bank account or a credit facility. This is the way it's been for a long time, okay? But the messaging architecture we used to use to get customers into the branch, it's no longer working. Look at newspapers. Now, this is a really shocking statistic for you. But this year, there will be less newspaper advertising on a revenue basis, inflation adjusted, than in 1950. Just think about that. There's less ad revenue for the newspaper industry in the United States this year than in 1950. Why? Well, it's pretty obvious, right? People aren't buying newspapers. We aren't reading newspapers as much. We now have our iPad, and some of us, I get my industry news on banking from Twitter. Through the stream on Twitter, not from a newspaper. I don't read the Financial Times anymore to get my news. I get far quicker updates on this stuff, better stream of consciousness through things like Twitter. And direct mail. Less direct mail will be sent, was sent in 2011 and 1990, right? So all of these traditional mechanisms that we used as a messaging platform to stimulate interest in our brand and get them into the branch, those messaging platforms aren't working. And yet, you ask community bankers, and they say, no, well, look, that might be the case for the big guys, but our customers still love coming into the branches because we're in the community, right? Well, I don't actually think that's the case. I think there's a bit of inertia from legacy customers, but the way consumers are doing their day-to-day banking doesn't lead them into the branch anymore. They just don't need to do that. And I'm going to show you some really interesting customer comments on this that's really, really insightful. Now, the problem also is that the way we sell and the way we engage hasn't changed in a long time. The ad on the left-hand side, my right, your left, this is an ad from a newspaper in 1953. And the one on the right is one that is running currently, right? The one on the left, incidentally, you can't see it, but it's from Allstate, right? In 1953. The messaging around financial services hasn't changed in 60 years. We're still saying the same stuff. And you know what we say? We say, we're going to save you money. We've got the best rates. We're different, right? How many banks say we're different? Pretty much all of them, right? And so as a result, we're all out there saying we're different, we're the best bank, we've got the best rates, the most branches. And what do customers think? We're all bankers, right? Very cynical view. So here's the problem. The core messaging approach that we use to attract customers, to get them in the door, it's broken, right? It's not just broken from a message perspective, it's broken from a platform perspective, it's broken from a metrics perspective. So how are we going to get new business? How are we going to acquire new business? This is a real challenge. Now let me tell you how this challenge is making itself evident from a data perspective. Now, the credit union business is quite similar in many ways to community banks, right? They're attached to a community. Maybe the community is intellectual or employee-based or something like that rather than in a geographical area, but often it's geographical as well. And one of the problems credit unions are facing is that they're not getting acquisition of younger customers. So in the mid-90s, the average credit union customer, the age of, was about 32. Now it's slipped up to 48, right? This legacy customer behavior, right? Those old customers still love coming into the branch, but they're not getting the new customers because they've been slow to adapt to internet banking and mobile banking, all those things. So they say, oh, our customers don't use that. But the problem is their new customers do want to use that, and their new customers don't engage in the old way. And so as a result, suddenly, very quickly, we found that the customer base, the age of the customer base in credit unions has got older very quickly. It's because those new customers aren't coming in. Now, there's a false sense of security here because the baby boomers and the older customers have all the cash, and so we're still profitable. But at some point, that falls off a cliff, and then you go out of business overnight, right? So unless you're getting that pipeline of new, younger customers coming into the business, at some point your business just ceases to exist because the economics fail. So where do we go from here? Well, the key problem is, the assumption is we're going to funnel customers into the branch. This is something we have to completely revisit because while, we even say we go down to the bank, it's a common language that we use to articulate how it is we do our banking. But do we go to the bank as much anymore? What's the number one channel day to day for banking in the United States? Internet, right? Internet's number one today. It surpassed the branch back in 2008. What do you think it's going to be in 5 years' time? Mobile, right. Now, we know where that's going. It doesn't take a genius to work out that mobile's going to be, the way people are doing their banking in the future, then internet and tablet. And so, where's that activity going to come from? Obviously, less people are going to be going into the physical place, right? Now, these are the stats that tell us that this is actually happening right now. So, in the United States, in-branch transactional activity has dropped off fairly rapidly. We're talking 60% since 2000. Now, the interesting thing is 2010 to 2011, we had a massive drop. Just 20% transactional activity in that 1 year. Now, why is that? Financial crisis, you think? Mobile banking, absolutely. Because 2007, 2008 is when apps appeared. Oh, we didn't even have apps until 2007. You remember that? Right? The Apple smartphone, that was apps, right? 2007. Now, today Google announced they just hit 25 billion app downloads in their Google Play Store. Apple reached that level at the start of this year. So we've got collectively, if you take BlackBerry, Microsoft, all these guys, we've got almost 70 billion app downloads that have occurred. And that is a business that's been created from nothing 5 years ago, right? Incredible, the growth rate behind that. But when you have a new channel grow in popularity that fast, it takes activity away from an old traditional channel that doesn't work as efficiently. You might say, but hang on. Branches are all about great service, great advice. But when we think about it, when we think about where we're going to put a physical branch in a community, which street we're going to put it on, which corner. When we do that analysis, we go through this process and we say, how many people are going to be going past the branch if we put it there? Is there parking nearby? Is it near the kids' school or on the way to work? Or is it near these communities? And what we're really doing in that analysis is saying, how convenient is it to get to that branch to do banking? There's a problem. That basic premise of branch banking is about convenience. It's just not as convenient to go to the branch as it is to fire up your mobile phone and do a transaction on the phone or use internet banking anymore. Right? That's the real core challenge we have. And if you look at visits, number of visits, this is a dramatic shift. So in the mid-90s, the average American customer would visit a bank branch 2 to 3 times a month. Now it's 2 to 3 times a year. That's a 90% reduction. This is not what's going to happen in 10 years' time. This is what has already happened. So we're thinking right now, we do these ads, we put a newspaper ad, we send a direct mail envelope out, and you guys will come into the branch and fill out some paperwork and open a new account with us. NetBanker has recently assessed that the average community bank branch in the United States only opens 4 new accounts every month. That's the average, right? The scary thing is, they also worked out that on average, they're closing 5 accounts a month. Now, this can't continue indefinitely, this trend. This is a challenge. Part of the problem is just the pure mechanics of revenue. We think the branch is where we record revenue. The branch is where we record account openings. The branch is where we record cross-sell and upsell. And the whole system is designed around customer comes in, open an account, and everyone's happy. And it just isn't working like that anymore. This is the challenge. And this doesn't count as a branch strategy, by the way. Right? So there's not a way to get customers to the branch. B of A might think so, but, you know. So where do we go from here? Some would say the real differentiation in the bank branch is advice. And I've heard this, in fact, I heard this last night, right? So you go, our customers come to the branch because they get great advice. So let me put this back to you. I want you to have a think about your own banking experience as a customer now. When was the last time you went into a branch and you actually got advice? Probably never. It just doesn't happen. It's a myth. That, you know, this, like you can come in and you can ask for help and you will get help, probably in the form of a product recommendation, but you will get assistance. But when was the last time you walked into a bank and got unsolicited advice on how to improve your financial health, right? Unless you're a private banking customer or a wealth management customer, this doesn't happen at mass scale. And I'll tell you why it doesn't happen. There are no metrics for a branch manager to give advice. He doesn't get rewarded on giving his customers advice, so why would he do that? It's not built into the system. Okay? There's one other challenge with this. The premise that a customer will walk into your bank branch and get advice is based on a very simple principle. Back in the 70s, you know, when the market deregulated, back, even in the 80s, you know, the premise of the bank branch was that you could walk in and get advice because your banker, when it came to a mortgage, asset classes, investments, credit facilities, he knew stuff about this business that you didn't know. Information scarcity was what separated a banker from a customer. He knew stuff that you didn't know. The problem today is that we have the internet. And the internet's like trying to take a drink from a fire hydrant. There's so much information we get that the typical banker sitting in a bank branch, they can't compete with the internet in terms of just sheer volume and depth of information. We've got private banking clients coming into private banks today, and the clients know way more than the relationship manager because they've spent the last 8 weeks studying this asset class that they're interested in investing in. And they come in, and the RM's a generalist. He's got to be able to cater for every sort of scenario. This guy comes in, he's spent 8 weeks studying solar silica mines because he's interested in green technology, and he knows that everyone's invested in solar cell technology, but he wants to get a jump on the market. So now he's looking at the mines that produce the solar silica, and he goes in and talks to the RM. The RM's got no idea. He says, well, we've got a green technology fund we can offer you, you know, but so this is an example of even at the top end of the market where advice is supposed to be the big differentiator, now the private bankers can't even keep up with the clients because information scarcity doesn't exist. Let me put it in context. From the dawn of man to 2008, it's estimated that mankind generated 5 exabytes of content. Do you know what an exabyte is? Well, we have kilobytes, megabytes, gigabytes, terabytes, petabytes, exabytes, right? I won't test you on it later, don't worry, right? But it's a lot of content, right? Cave paintings, art, music, written texts, 5 exabytes of content between the dawn of man and 2008. We now generate that same amount of content every 3 days, right? So information scarcity, it's gone. Doesn't exist. Advice as a differentiator doesn't exist. You can still give advice, but the trick with advice will be context. How you help a person with their financial life when and where they need help. And that's invariably not going to be in a face-to-face interaction in a branch. Now, the problem is that with these mechanics changing, the profitability of branches is changing as well. So if you've got a branch that has under $15 million in assets, these branches generally in the United States are no longer profitable. And this is about 18% of the branches in the United States. So if you add in customer behavior and this figure alone, what that means is by 2020, about half of the branches in the United States will probably close. That's a pretty shocking statistic, I know. But that is likely what will happen. If you've got branches that are in this range, you need to start thinking about 2 strategies. One, how do I downsize this to a service place rather than being a transactional place? Just a small place where a banker can service customers' needs. If they come in, they've got a problem, they can answer that, but it's not a transactional place. And then, if you've got a few of these, which ones are the first ones to go when the crunch comes? Because the economics, they don't lie. This is, at some point, it's going to get to this point. Now, some bankers say, but hang on. Apple is really great at stores. If we just copy Apple's format, we will have no problem getting customers back in the branch because those stores are full all the time of people, right? So if we just get the branch right, we can get this all sorted. We put some nice digital screens in there, put a coffee machine. They can come down for yoga lessons in the afternoon. I don't know what, but is this the secret? If we fix the branch, will this get people back in the branch? So let me put it this way. I'll make this pretty easy for you to work out. How many of you have an Apple product? An iPad, iPod? Wow, phenomenal. Apple's just done amazing things the last few years. Okay, so did you buy that in a store? Can I have you put up your hand if you bought your Apple product in a store? It's interesting. Few bought it online, but most of us bought it in a store. So you bought was it an iPad? Is it you got? Great. You bought it in a store. Great. So do you go back to the Apple store where you bought that to buy your apps for your iPad? Why not? The store's the great customer experience. They have geniuses there. Why wouldn't you go back to see the genius and get your app? We just don't need to. Now think about this. Banking products and services. Can I borrow this for a second? Are they more like this, amazing piece of technology that you have to touch and feel to figure it out? Or is it more like an app? A checking account, a mortgage, a credit card. It's much more like an app. So when you look at behavior, we just don't need to go to the store. And building a better store is not going to change that behavioral imperative. Now, I'm sure some of you are sitting there going, yeah, I've heard this before. A lot of people have been talking about the fact that branches are going to disappear, and they've been talking about that for a long time, and we're still here. So rather than hear it from me, I thought I would let you hear it from a typical American community banking set of customers. Now, this group that we interviewed on camera, which you're going to hear from in a moment, the only control question we had, we didn't ask them if they use internet banking, mobile banking, none of that up front. All we asked them was if they banked with a small community bank or a credit union. And if they banked with one of the large guys like B of A, Chase, or Wells, or one of them, we ignored them. We wanted to get in the mindset of the community banking customer, okay? So these guys are just customers of smaller institutions. And this is what they have to say about these changes.
Basically, only to make deposits.
I don't go to the branch of my bank very often at all. I went there to open the account. I went recently to open a new account or get something notarized, but otherwise I do everything through online or through the ATM.
I would say I visit the actual branch to use a teller once a year.
Maybe once every couple of times a year, if that.
It's decreased every year. It gets less and less that I actually visit the branch.
Once every 2 months, maybe?
I would say I would be less likely to visit the branch in the next 5 years.
We probably are going to visit about the same amount, but maybe less because we are doing more online now.
Nowadays, I normally go to my branch about 2 to 3 times a year.
I don't visit the branch as often now because I do more online banking.
I probably visit my bank once every 2 or 3 years. I haven't visited in a long time.
I use mobile banking because it's more convenient. I hate going to a place to do my banking. I would much rather do it from where I'm at.
If our bank started to offer more internet services, I would probably do more on the internet than actually going, because it's more convenient to do that than to actually go to the bank for us.
Yes, I regularly use internet banking.
I use internet and mobile banking to check my account, to transfer money, pretty much just to check my account and or to transfer money.
It's easy and it's never closed to use the internet banking.
Yes, actually, I have the iPhone, and it did not previously have a People's United Bank app, but up until about 3 months ago, they had one, so I uploaded that immediately and I started using it, and it's been great ever since.
The Wilton Bank at this point doesn't have an app for my iPhone in order to make that easy.
Both. I use internet and mobile, but mobile a lot more. No, they don't give me advice. No, they try to be
Well, they probably would give me advice, but I haven't taken advantage of it.
My bank does not give me any regular advice on what to do with my money.
Right now, it's getting less personal in a way, where I don't get as much feedback as far as what to do with funds or how I can save, or there's not a lot of advertisement as far as how to help me save money or other loans or things available to me. I like to see more of that, maybe even coming through on my app, my mobile app.
No, they don't give us any advice on our money.
I have never really inquired about it, so no, I've never really gotten any advice from them.
I don't think my bank has ever given me advice on what to do with my money.
Most likely, I'll stop going to the brick and mortar and just start using the phone for everything.
Probably on the mobile phone. I see that becoming a bigger piece of my weekly routine.
Similar to what I'm doing now, but maybe even more intensely, using the internet.
Over the next 5 years, I will probably visit my branch less than I do now.
I think that I'll continue to do it online. Hopefully I can do more of it online than I do now. And I would assume that I'll probably start doing it on a mobile device, iPad, iPhone.
I would imagine that I'll eventually own an iPad, and I would probably do most of my banking on an iPad. I find the telephone screen to be a little too small to work on.
Probably in the next 2 or 3 years, I'm going to do my day-to-day banking primarily and mostly using mobile banking.
Interesting, huh? So this is the average customer. Now you notice they all pretty much said the same thing. They're using the branch less than they did before. They're using internet and mobile more. But what was the reason that they gave for not using the internet and mobile? The bank didn't provide it. And then as soon as they did, like the girl said, I was checking, I was waiting, and then they had it. And so I downloaded it straight away and I started using it. That's behavior. That's the common behavior. Now, she's in the Y-Gen bracket, right? But Beverly Resnick, she was the 60-plus senior that you saw there, and she said she does most of her internet banking online. And she's been with her bank for 37 years. And what did she say about getting advice from her bank? No. She said she's never got advice from the bank in 37 years. So what is differentiating her bank from another bank? For her, it's utility. Being able to get online and do her banking. It's not the fact that she comes down the branch and gets great advice. And it's not going to be a future differentiator. So here's the thing. This behavior that we used to have of going into a branch and doing banking, it's never going back to that. It's never going to get back to the way it was. These changes we're seeing now are permanent changes in the way people bank. Sure, some bank branches will survive. Sure, we will need to go into some, a space time, from time to time to get support and service issues resolved. But this is not the way we will think about banking in the future. This is not the way it's going to be for us from this point forward. It's changed. So having that perspective, knowing that the way people will do their day-to-day banking has fundamentally and irrevocably changed from this point forward, why would you wait on investing in mobile or social or internet? It makes no sense at all because you're going to have to do it. There's no choice. It's not even a choice about when you're going to do it now, really. Now, how are we going to engage customers? We can't send out newspaper ads, TV commercials, radio, billboards, all that stuff, and hope to funnel them in the branch anymore, so how do we engage? One of the things that's emerging very strongly as a way to engage consumers is advocacy, brand advocacy. And this is largely as a result of social media. So people are talking about brands a lot more. They're engaging based on what their friends say, what their friends recommend. I mean, we do this for restaurants now. We do this for products and services we like. We've become, we used to do this, like you think about the old days, we would go to a friend's place for dinner and they'd buy a new car and we'd say, what do you think of it? Do you like it? Now we've just put that on Facebook and Twitter and these other channels. It's human behavior. It's not new. Okay, now we have a technology platform for that. But now we're listening to that voice a lot more because it's more readily available, particularly in our community of friends. So look at this. This is a university on the west coast of the United States. Can you see a brand that's done quite well out of this advocacy thing? Now, you saw one of the signs out there, right? Tablets are going to overtake PC sales within just a couple of years, right? And we know PC sales are plummeting, except for one company who's having no trouble selling PCs at the moment, right? They call them MacBooks and things like that. But look at this. 78% of US-based Gen Ys have bought a product based on a friend's recommendation. Does that surprise you guys? Shouldn't, right? And 66% of them have visited a physical place based on a friend's check-in. Oh, my friend's been to this restaurant, I'll try it out, right? So this is advocacy at work. Now, to put this in perspective, do you know what the #1 search engine in the world is? Google, right? Yep. YouTube's #2. Very good. Who said that? You get 5 points. Good. She beat me to it, so that was great. So YouTube is now the world's second largest search engine. Why? Because this is how customers talk to each other now, right? In the past, we would go into a store. Why? Because we wanted to touch and feel the product. This generation, the Y-Gen, they don't want to touch and feel. They want to see and hear. And that's what it's about. Their search and product selection is visual and based on advocacy, right? Can I see the product? Can I see a video on the product? do I have affinity with the brand because my friends buy it as well, right? So the old days used to be all about that experience of touching and feeling something. And there is still a little bit of that for some of the products, but seeing and hearing about the brand has become much more dominant behavior for this generation. So you see why getting them in the branch actually is counterintuitive for these kids. It goes against their instinct, right? If you say to them, you've got to come down and sign a piece of paper in the branch, they're like, huh? What? This, by the way, this is a 21st century, you know? Google doesn't need us to do that. Facebook doesn't need us to do that. You know, mobile phone companies don't need us to do that. Prepaid debit card companies don't need us to. Why do you need us to do that? We can do everything else. You know, we can buy our airline ticket online. We can download a boarding pass to our phone. We can get on the plane using our phone. Why do I still need to come to a branch to sign a piece of paper? Oh, well, the bank policy compliance officer says, okay, you're irrelevant. Sorry. I don't get that. I don't understand. And so this is the way they communicate, and this bridges cultures. You know, in China, Han, he's had over 300 million views to his blog. That's incredible, right? And then here in the US, Elle and Blair Fowler, these girls record a weekly video. They call them haul videos, and then they go out shopping to Forever 21. They bring back these clothes, and they say, this is what we're wearing back to school, and they do makeup tutorials, and they tell you which jewelry to wear with which clothes and all this sort of stuff. These guys get 1.7 million views on average per video they post every week. Now, to put that in perspective, you take the 7,800 financial institutions in the United States and you aggregate all of their views on YouTube that they get less than 1.7 million views per year collectively. And these guys do that every week. So who gets advocacy? Us as industry or these guys? So we've got to start communicating differently. We've got to start thinking about the acquisition and connecting with customers in a very different way. And Instagram, Pinterest, these new technologies are hooking into the see and hear phenomenon that this new generation wants to engage with brands. I mean, Instagram's incredible. It's just grown in a couple of years to 100 million users, over 1.2 billion images loaded. Visual. Have you guys seen the new MySpace, by the way? So, MySpace was owned by News Corp. Well, News Corp sold it. They sold it to a group. And one of the owners of MySpace now is Justin Timberlake. You've heard of him, right? Go and have a look at the new MySpace, okay? It's all visual. It's all visual, sound, seeing and hearing. These guys have worked out. And I think it's going to be really, really interesting. Just the last 2 days it was announced what they're doing. So this is the new way of connecting. This is the new way of bridging the gap. Now, the problem for us is this. I'm putting out these messages, you can trust us, we're the best bank, we're in the community, we know you, we've been here, we can relate, we've got all this experience, we've been in the community for 80 years. Unless my friends tell me that you're cool and I can trust you, I'm not interested. I'm going to trust my friend's recommendation over what you say in an ad every single time. That's the challenge. That's the problem. So how are you getting your customers to recommend your bank to other prospects and other customers? That's the question you've got to answer. Now, the only real way to do that is provide great service. And how do we perceive service now from a customer perspective? We measure service. We, in fact, measure service experience by how quickly and well we process you and deal with you in the physical place, in the branch. That's not how these guys measure service now. They measure service by, can I pull out my phone and can I get what I need done on my phone? And if I can't, that's bad service. And you go, but you can come in the branch and we give you great customer service. We have tellers and geniuses, Sorry, I need it done now. And you guys making me come down the branch and sign a piece of paper? That's not great service. That's the opposite to great service for me, right? That's a hassle. which is why today the fastest growing deposit product in the United States is prepaid debit cards, because it's the least friction for these guys to get a basic bank utility. Now, I know you'll jump in there and you'll say, but hang on a second. They can't get a mortgage off that, and it's not like a big relationship. You can't cross-sell and upsell and all of that. What happens when they need a mortgage? What happens when they need a car loan? They're not going to be able to get that from Green Dot or Walmart. But that's not the point. Point is, this whole loyalty thing, this primary financial institution relationship that we've relied on so long as an industry, you come in the door and once we've got you, you're going to get all these other products from us. That just doesn't exist for this generation. And I know you had a question there, but we will get to that in a moment. Oh, for the prepaid debit cards, the fastest growing. So Green Dot, Walmart, these sorts of organizations, this prepaid debit card, this is we used to call them gift cards, right? But now you can use them as a bank card. And this is now 200 billion, the size of this market. Now, the very interesting thing about the prepaid card market, having grown so rapidly to 200 billion in deposits, and let's face it, this is a $9 trillion industry, so it's still a small part of the deposit base. But the assumption is that prepaid debit card customers are the least profitable, and they're at the lowest point on the economic value chain. They're the poorest people, they're unbanked, and that's the only product they can afford because they don't have a good credit rating. We found out that actually isn't the case. We found out half of the customers that use these prepaid debit cards have college degrees, and a quarter of them have a credit rating better than 700. So the reason they're choosing a prepaid debit card instead of a checking account is something else, and you'll find out what that is in a moment. So 1 in 3 Americans will be using mobile banking this year, right? Will have used it. Now that makes sense, right? It was 1 in 5 at the end of last year. Mobile smartphone adoption rates are at about 50% in the US and growing. iPhone 5's just come out. It's a big deal. The Samsung Galaxy 3, it's a pretty cool piece of kit as well. So, you have rapid adoption. Interesting thing is that within 2 years, a basic entry smartphone essentially will be free, right? And even in China, they estimate within 4 years that 80% of the Chinese market will own a smartphone, right? So this is pretty much everybody will have a smartphone by the end of this decade. And they're going to be the core day-to-day banking product. The fastest growing merchant solution in the world is Square. You guys heard of these guys? Now, this is really interesting. Visa, MasterCard, Discover, Amex, these guys built their businesses over decades, and in the US, there's 8 million merchants, okay? 8 million merchants that have credit card facilities. These guys are 2 years old, and they have 2 million merchants. We have never seen the growth of a merchant acquisition business anything like Square. Not even close. Nothing has even come close to that. So what has Square done that's so exciting? Well, you might say, this is pretty cool. You take out your phone, you put a little plastic dongle in the top of your iPhone or your BlackBerry or your Android, and now your phone is a point of sale. Obviously, that's the really cool thing that they've done. No, that's not what got them 2 million merchant accounts in 2 years, right? If you were a small business operator in the past and you wanted a merchant account, you'd go down to your bank, whether it's a community bank or the big boys, and you'd say, I'd like a merchant account. The first thing they'd say is, do you bank with us? We can't help you unless you bank with us. You've got to have your company accounts with us. Yeah, I bank with you. Okay, how much money are you going to do through the merchant account? Oh, I don't know, maybe, I don't know. Well, you've got to do $100,000 a year or we're not interested. Okay, I think I can do that. Okay, here's a contract from MasterCard, here's a contract from Visa, here's a contract from Amex, here's a contract from Discover, and here's a contract from the bank. And we need a deposit for the point of sale unit. And if you don't use it enough, we'll take it off you. Right? Square said, great opportunity for disruption here. And this is how they do merchant acquisition. You get online, fill in your details, put in your bank account details, your social security number. We send you out one of these plastic things in the mail. 3 days later, you now have a merchant account. You can take take credit cards, swipe them on your phone. They killed the friction in merchant onboarding. They got rid of the friction in merchant onboarding. That is what created such a phenomenal success behind Square. Now, let me ask you this. We don't have a lot of friction in banking, do we? Process friction, there's not much of that, right? In fact, we have a special name for it in banking. You know what we call it? Risk mitigation, right? We have our own special name for friction. We love it that much. There are no compliance or risk guys in the room, is there? I'm going to get in trouble on this. And this is what the disruptive guys in this new distribution layer of banking technology, this is what these guys are going after. Look at the two fastest growing technologies in consumer banking in the US today. Square on the merchant side, prepaid debit cards on the deposit side. What do they both have in common? They got rid of the friction, and you don't need to go to a place. That should tell us a lot, okay? You've got to make it simpler, and you've got to make it when and where the customer needs it. They're the two key ingredients to the success of these startup businesses. So by 2016 or 2015, 70% of YGens will have their preferred day-to-day channel as mobile banking. By 2016, the rest of us, half of us, mobile will be the number one channel. So how does this reflect in the order of things at this point? Mobile's number one, internet and tablet is number two, then ATM is number three, call center, we probably still have to call the call center a few times a year when the bank stops our card because of a fraud issue, right? And then maybe once or twice a year we visit the bank branch. So this means that your average customer is having a contact with your community bank 250 to 300 times for every one face-to-face visit in the branch. So if you think the branch is where the magic of the relationship happens, this is where we provide great service, this is where we differentiate, you're in trouble. Because another bank has got 300 more times to impress your customer, serve that customer, and give him a great solution to his problem for that one or two times a year that you manage to get your customer into a branch to sign a piece of paper. You with me? It's the total relationship. The bank is a service platform. We call it financial services. Service doesn't just happen in the branch anymore. In fact, it's far less likely to happen in the branch than these other channels. The branch is suddenly not the most important channel. In fact, it might be the least important channel. Now, I know this is a contentious point. I know, but we've got to cater for this different behavior. There's got to be legacy behavior. There's going to be customers who still like coming to the branch. We can't get rid of all of our branches straight away. I get that, but that doesn't mean we can't and shouldn't be deploying mobile, internet, tablet, etc. We just got to do that. It's a hygiene factor. Now, mobile payments is not going to be, one solution here. We're going to have to experiment with different things. There's going to be cardless solutions. There's going to be NFC, near-field communication technology. There's going to be phone-to-phone, P2P, peer-to-peer payments, all these different things. And you're going to need good partners like ACI to sort of help you navigate this, because as community banks, you're not going to be able to afford to do all this stuff yourself. You can't build it from scratch. The big guys might be able to do that. You won't. So you'll have to rely on A, your partners and vendors, and C or B, you'll have to rely on collaboration. Get together with other community banks who are having the same problems and see if you can solve this problem collectively. There's already organizations like Kasasa and others who are trying to do that type of thing. Branch sharing, those sort of things are part of that as well. But the challenge for us is this basic bank account, the value store. We're starting to see versions of this value store pop up everywhere. Starbucks now has a bank account, right? iTunes now offers a bank account. Okay, they're pretty limited in terms of their functionality, but they still take deposits and allow you to purchase at a point of sale. What if iTunes suddenly said, we're going to support all of these range of retailers, and everywhere you got your iTunes account, you can now use your iPhone to pay in the store? Well, they'd be a competitor for the basic bank account. It's not that far-fetched to think that that could happen. You might think, oh yeah, but that you still need a debit card to plug into that. Well, you could get a prepaid card. Or you could just use iTunes vouchers. You go and buy iTunes vouchers. Maybe you go to Apple Store to deposit your cash. That'd be interesting. Who knows? Now, the challenge with this is this behavior, what's really unique about this behavior is this is a shift, a fundamental shift in behavior because the digital natives, the Y-gens. From this point forward, this is the way, by 2020, half of our customer base will be Y-gen. So we've got to get this sorted out in the next couple of years. And for them, things like mobile phone is not new. It's just normal. Right? Any of you got teenage kids? Yeah? Okay. So let me ask you this question. If you need to get in touch with your teenager, would you have more chance of getting them to answer a text or answer the phone if you call them? Right. That's a no-brainer, right? And this is why they send 3,500 text messages. This is the average for an American teenager. This is not a freaky outlier. This is the average. This is how they communicate. They don't use email as much. They call it inboxing email. They don't even call it email. And they talk on the telephone 20% less than the preceding generation. You don't have to teach them how to use a smartphone. Don't have to teach them how to use the internet, social media, digital technologies like this. You might have to teach them how to use one of these, right? Most of these kids have never used a landline. My 9-year-old son, Matthew, he was watching this Disney show the other day, and I'm sitting there with my laptop working while he's watching this. And there's this girl on the show, and she's lost her mobile phone. She's frantic. She's looking around. And then she says, oh no, I may actually have to use a landline, she says, right? So this was the joke on the TV show. Well, my son, of course, Matthew, 9, he turns to me and says, Dad, what's a landline? And I realized since we moved to New York, we moved to New York and we get a bundled thing, TV, cable, internet, phone. We tried to get it unbundled. You can't get it unbundled, right? You've heard this story. There's probably ads about this, right? But we had a landline, but we'd never used it. We'd never plugged a physical phone into it because my wife and I just give our mobile numbers as contacts, right? I'm sure you guys get this. In fact, it's over it's getting to the point where almost 2/3 of Americans now have abandoned their landline. So this is a common thing. But I thought, well, hang on, my son can't go through life without never using a landline. So I went down to Radio Shack and I bought a handset, right? So I brought it back home and I plugged it in and I explained to him, this is how, I said, you've seen these before, haven't you? No, Dad. And I said, what about when we go to hotels and things like that? You see the phone on the desk. He's like, maybe, So anyway, I plugged it in and I explained to him that we used to plug phones into the wall. And he asked where the wires go. And then I had to explain about switching technology. And anyway. So I gave him the phone. I said, why don't you call your mother? So he picks up the phone and the first thing he realizes is it doesn't have a screen. But it's got buttons, so I think he's okay with this. It's okay. And so he goes like, Dad, I think it's broken. It's making a funny noise. That's dial tone, son, right? So you don't have to teach these kids this, but you may have to, teach them how to do banking the way we do banking. But how would you deal with a customer who's grown up like this? Who's grown up with an iPad? That's Thomas, my son. These are my 3 kids, Thomas, Hannah, and Matthew. And Thomas, he needed a haircut there when I took that photo, obviously, but he's the youngest. He's 3. I joke about this. There's two times you can take his mother's iPad off him, which he now is quite possessive of, which is when he's asleep or if he's dead, right? And he's been a native on the iPad since he was just a child, just like this girl who's a friend of a daughter of one of my friends. Found something to interact with, right? Where's the button on the iPad? I'll play with my knee instead. What does she want? Listen to her reaction. She loves it. So, you might think, well, fine, we've got 20 years before she's a customer, but every student coming out of university now, this is what they're like, okay? So you might have to teach them how to use these two things, right? They might not understand what these two things had in common, or why on earth you had to rewind these before you took them back to the video store, right? And you remember they used to fine you if you didn't rewind them, right? Yeah? And in the same vein, you're going to have to explain why on earth you would have used these things to send money, right? And guess what? First thing, university student comes out, gets in the workforce, right, I need a bank account. And what's the first thing we try and sell them? A checkbook. And they say, I'm never going to write a check in my life. And you say, don't worry, they're free. And they say, sorry, it's irrelevant. I don't get it. I don't understand it. Why would I ever sign a piece of paper to send money? And what, you got to send it in the mail? I've never even sent an envelope in the mail. In fact, about 40% of American university graduates today, they don't even have a signature. They write their name when you ask them to sign. Why? They never need to sign. They do everything digitally. They have to learn to sign. And here we are selling them checking accounts. The problem is, call them checking accounts. We shouldn't even call them checking accounts for this generation. They're not interested. That's why prepaid debit cards are the fastest growing product for this generation. Not because they can get them at Green Dot or Walmart, because they just don't get checks. And that's the only product we sell them when they walk in. Behavioral shift. So how are we going to market? How are we going to engage? Let's talk about that. Well, there's a lot of data we can get now and we can use. We're calling this new field the quantified self. And, we get this data in and we can pull it in, health data. We can measure our heart rate by shirts that we wear. This is the Under Armour E39 shirt that measures your heart rate, calorie burn, all this stuff. Or the Nike Fuel Band you can wear. We're getting all of this data about our health. But think about all the data we have about our customers' financial health. And, we can see, we ask them for this, for an account opening, because we try and assess their risk based on this event. But what if we looked at their financial health day to day based on data and we use that? That'd be a much better predictor of risk. How well are they saving? How often do they spend all of the money they get each month, when they get paid their check, their salary payment? Do they, how quickly do they blow through that? That is a better predictor of the likelihood of default on a loan or a credit facility than what their credit score is. So we should be doing this assessment on our customers all the time and then figuring out, is there a way we can give them advice to help them improve their financial health in real time? This is the future of the relationship, the engagement model. And we start to then make financial services contextual. So instead of trying to sell you a travel loan or travel insurance on the bank website or get you in a branch to sign a piece of paper, we now embed things like travel insurance in a travel website. Or we know that our customer is going to travel because he used his credit card to purchase an airline ticket and we know what date he's traveling, and then he turns up at an airport. So then we can send him a message saying, hey, you're going to travel. Do you need travel insurance? And suddenly, instead of the customer saying, whoa, hang on, the bank just tried to sell me something, they go, oh, that was great service. This is a great help. This is positive. And in the same vein, when we're out looking for a car and or shopping, these are times that we need the bank to be connected to us. Credit card usage offers. It's better if we walk into a store and you say, hey, if you're at Best Buy, the showroom for Amazon, That's the joke, right? We got this deal. If you use your Gold Visa credit card, we can give you a discount if you shop today using our card. That's a better level of service than sending me a direct mail envelope telling me next month I get 10% off at Best Buy, right? Or when I'm at a car yard looking to buy a car, that's when you need to be able to tell me how much I can afford and offer me a loan right there on the spot. You can imagine, this is a typical scenario. I go down to a car yard, I find the car at the car dealer, I find the car I want to buy, and I ring my bank, and the bank says, whoa, 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 hang on a second. We haven't even decided if we're going to lend you the money yet. You better come down, do the risk process, and maybe, if we're lucky, if you're lucky, we might let you have a car loan. Now, we can't do that anymore. You know why? Because we go to the car dealer, and if the bank says, oh, well, we need time to assess this and you need to come down and fill out a form, the dealer will go, no, we can give you the loan. What's the interest rate they're going to offer you? Yeah, we can match that. So if you can't do the risk assessment in real time and deliver the product when and where I need it, you're not going to get the business. And it's the same for a mortgage. See, we got into the habit of thinking as banks that we sold car loans and we sold mortgages and we sold checking accounts, but we don't. People buy cars and they buy houses and they go shopping. They don't buy financial products. The financial products facilitate their life. That's the utility of the bank. And what we've done is we think that we're so special as banks that we can have a separate product that sits off to the side and stops a person from their normal purchase process, diverts them to the bank branch, and then when we're ready, diverts them back to purchasing the home or the car. That is not going to work any longer. Financial services are becoming contextual, when and where I need them. But for us to make a decision as a bank that's not risky for the bank, we have to really know the customer. We have to be able to think about when they need this and be able to offer it when and where they need it, but do it safely, securely, and assess risk appropriately. Primary objective here, get rid of the friction. Now, the compliance guys will tell you this is scary. This creates lots of risk. What about security? Let me give you an illustration I use in Bank 3, the new book that I've got. I tried to figure out how would I have this conversation with a bank compliance officer to illustrate that this shift could actually be positive rather than always being seen as a negative, challenging the existing process. And I came up with, I think, which is a great example. You imagine if today you went to a compliance officer and you tried to sell a compliance officer on this brand new strategy you had for cross-sell and upsell with customers, which was, every month, what I'm going to do is I'm going to print out all of their bank details, all of the transaction information they've done. I'm going to put their name and address at the top of this piece of paper. I'm going to shove these marketing offers in the envelope that's unsecured, and I'm going to send this out in the mail. There is no way on earth a compliance officer would approve paper statements today. It just would never happen. Because from a security risk perspective, there's no way it would get past compliance. And yet we do that every day now. And we think that's okay. And we think this is risky? We've got to start rethinking the reference of financial services. We're going to start using things like voice biometrics and data about how you behave, how you pay. This is how we'll identify you now, not your date of birth, your social security number, your address, because that information is no longer secure. We have to now start identifying the individual in different ways. And behavior will be key to this. Behavior is the key. Mobile plus behavior equals context. So let me sort of wrap it up with this. This is what we're doing at Movement Bank. And I want to sort of talk about behavior and the way we apply this. So with Movement Bank, we don't have any branches. We don't have any plastic. You don't even get a physical card. You have to use a phone to pay at the point of sale. So you either get a sticker, which you stick on your phone, or you use one of these new near-field communication-enabled phones that have the chip inside that enable you to do contactless payments with your phone. Now, in the US, contactless point-of-sale terminals are still being rolled out, but obviously over the next few years, this is going to be more commonplace. But this is how we do behavior. So when you stick your phone on to get paid, or pay at the merchant, we give you the receipt on the screen. right? Now, that's not a big innovation. Square does that. PayPal does that. Amazon does that when you buy stuff. But then we say something simple, like you go to a coffee shop every morning to buy your coffee and bagel. And we'll say, okay, you spent $10 on your coffee and bagel. Hey, but did you know you've spent $400 at this coffee shop this month? And you spent $1,200 on eating out, just letting you know. Now, if you're trying to watch your savings, watch your spending habits, what happens tomorrow morning on the way to work? You think, $400? I had no idea I spent that much on coffee and bagels. I think I'm going to give it a miss. The coffee at work's bad, but it's not that bad that I can do without the Starbucks for a couple of days. And suddenly you've changed your behavior. So this is the type of advice that you can give in real time to customers that you could never give through a branch. So here we are thinking the branch gives a superior experience when we think this is far, far superior from an advice at scale perspective. So don't think of mobile and internet being inferior service experiences to the branch. It just doesn't have to be like that. So to wrap it up, this is the car I'd like to buy when I grow up. Maybe not, my wife says, but she says I've got to sell a lot more books before she's ready to let me have one of these. But this is the Audi R8. Now you can imagine driving in a car like this. You might want to, the girls might want a Ferrari California or something, I don't know, or maybe the Rolls Royce might be more your style. I'm not sure. A Mercedes SL. You can imagine driving in one of these cars. It's the experience of the journey is fantastic. You feel like $1 million. It's not just getting from point A to point B anymore. The journey itself is special. Now, as banks, we've become very, very focused on the destination, right? And we don't care how you get there as long as we get you in the branch and sign that piece of paper. We're focused on the destination, not on the journey. Not how our customers are using the product, why they're using the product, when they need it. We're just trying to get them to the destination. We've got to stop thinking about the destination and start thinking about the journey our customers take. Now, there are organizations who are pretty good at this, like Apple. In fact, they're so good at it, people camp out waiting for their new iPhone. Right? We've seen that in the last couple of weeks. I don't know about you guys, but do you roll up to your community bank in the morning, the branch, and there's people camping outside waiting for their new checkbook? No? Doesn't happen? Or coming out with their new credit card? Facebook! It doesn't happen like that. How are we going to create these types of journeys and experiences for our customers? That's the challenge you guys have to start thinking about. And what ultimately it means, to sort of sum this up, banking is no longer that place you go. Now it's something you do. And you guys have to enable the do for your customers, not the place. Help your customers do banking with your bank, not go to the bank. And that is what I like to call Bank 3.0. So we've got time for a couple of questions? Yep. Please.
You started off talking about advice and how people get advice, but then you came back and said we got to provide advice. So
Right.
I'm kind of confused on the advice.
So advice at scale, can be done based on behavior far better than it can getting you into a physical place, right? Because if I understand your behavior, I know when you need help, and as a bank, I'm really well positioned to give you that help. The big problem with advice in the branch is that you've got to get them just at the right time when they need that advice, and you've got to be sure that the person who's going to serve them is capable of giving them that advice, and you've got to have the system support to be able to do that. So, they're all challenges in their own right, but if you understand their behavior and you see where they are and what they're doing, and like you can see they're at a car dealer, then hey, do you need a car loan? Are you thinking about that? Or can you really afford a car? Context and behavior will give us opportunities in terms of helping our customers that we could never get without that context of that information or data. And that's really the key point. Yeah. Because when you think about bank products and services, there's always some trigger for a bank product or service, right? And if we understand what that trigger is, and when the trigger occurs, then when we provide the product or service, it's actually a solution to a problem. Where we don't want to be the problem, right? Which right now, because of friction and credit scores and all these sort of things, we have become the problem. So we want to change that to be the solution. The only way is anticipate their behavior or their needs and serve that behavior or need as it happens. That's ultimately where it's going to go. This is going to take, 5 to 7 years to sort of really flesh out. But if you guys know where it's going, you can start planning for that already. Any other questions? Okay.
When does your new book come out?
Oh, the new book, Bank 3, comes out on October the 25th. You can pre-order it from Amazon right now. I have given the guys a sample chapter. So you guys, I think everyone's going to get a copy of that. So feel free to have a look through that and see what you think. And it should be available on Kindle as well as, old style. There's a lot of bankers that like it in print, apparently. I don't know why that is, but... Okay. Well, look, thank you very much, guys, for your attention and listening to my message. And, I'm available on Twitter. Brett King on Twitter, or you can get me on Facebook. And if you want to continue these discussions offline or have any issues, I'm going to be here for the rest of the morning and happy to catch up with you offline on any questions you might have. But thank you very much.